Good morning, everyone, and welcome to this week's podcast from March the 14th, 2022. My name is David Clark, and I have Will Gibson joining me this week on the podcast. And Will, as we came in this morning, we saw equities begin to trade lower. And when we look at that default chart of the S&P 500, we see that it's going to give a second consecutive sell signal as it broke a double bottom there at 4,200. At this point, we've seen equities rebound with today's action, as we've seen the Dow and the S&P move back into positive territory. But again, definitely worth noting that we've seen that default chart move back to a sell signal. But that really is the beginning to a week that, we've seen a lot of price volatility over the past 2 weeks. That story continued much in the same as last week. We saw that first sell signal for the S&P 500 given following last Monday's action. And now with this Monday's action, it's moving to give that second consecutive sell signal. And really, that's been the general trend of equities over the past week, is that we've seen them pull back. And it really isn't the only thing that we've seen pull back, though, is we've seen commodities pull back, and we'll get to that here in a moment. But first, we wanted to spend a little bit of time on equities and sort of the current stance, what we're looking at. But then also, we know we have the Fed meeting coming up this week, and at this point, it's pretty much the foregone conclusion that we're going to at least see a quarter point rate rise out from the Fed this week. So with that in mind, we wanted to take a look back at some of those rising rate environments. Granted, it's a little bit of a small sample, especially over the past 30 years. But take a look back at those rising rate environments and look at some of the sectors that we've seen perform well, which ones have done better than others, and what does that picture look like 12 months out? And Will and I were sitting here talking about the data, and it's really interesting to see that 1 month is, you get a bit of a mixed bag as far as performance go, but generally speaking, 3 months out, you see most sectors in positive territory. So that's a positive sign in the realm of seeing a potential rate hike coming up and what the reaction may be from historical periods and looking at what sectors have done well. The main sector that we see really kind of take it to, for the lack of a better phrase, take it to the chin, in 1 month out from a rate rise is materials, which is currently sitting in second place within our Dolly sector rankings. But then from there, interestingly enough, the sector that performs the best 1 month out from a rate rise is energy. So seeing a very interesting picture when we're looking at where Dolly currently positions us, what we've historically seen perform well, and this is using S&P sector stocks and looking at those forward returns from those times that we see rate hikes to the time periods that we've examined, the 1, 3, 6, 9, and 12 month. And again, we're just in a somewhat interesting environment. And Will, I know you had a couple good observations there as far as looking at some of these other sectors that I didn't spot, but that's why two of us are on this podcast.
I don't know if I call it good, but just some general points to tack on here is that you're right. Over the overwhelming evidence was that equities were positive after the rate hikes, and this was after the announcement that they were actually going to raise rates. So something to keep in mind is that markets are forward-looking. So markets likely already priced in a lot of this action ahead of time before you actually got the announcement, if you will. Like David, you're saying, if you look at Fed futures right now, or really read anything, there's pretty much a wide consensus that this is going to happen on Wednesday of this week. So a lot of that market action probably priced in ahead of time, and that should be considered when you're looking at this data as well. Also worth mentioning, it's been a generally trending, or rates have trended lower on average, at least for over 20, 30 years now. If you look at any chart, you're going to see these blips of rising rate environment. 2004 to 2006 was a big one, and that's a big say in the data set here, what we're looking at. You also, of course, saw, I think, a little bit in 15, 16, ended 18, or actually throughout 18 for sure, just really capitulated into that equity market sell-off at the end of 18. So a small sample set from a number of count, 34 observations, 34 total rate hikes from February of 95 to December of 18. And that's not to mention, cycles, if you will, much fewer cycles, I would say, that you're actually looking at within that time frame. So small data set, plenty of room to say that these times could be different. Like every instance seems to be much different, but you're right. On average, you saw some pretty bifurcated moves, especially over the 1 month. Those tend to smooth out 9 and 12 months out. One observation that was a bit odd, that we saw materials of the sectors lag over 9 to 12 months following these rate hikes, whereas energy as a sector did very well. Both of those being, I would say, commodity focused or commodity tangent areas of the market. So that was an interesting observation. We have seen materials and energy rank pretty highly in our Dolly sector ranks. David, you mentioned materials moving up there. First time materials hit second place in our Dolly sector rank since January of 2010. So doesn't often make trips up here. And if I remember the data correctly, it hasn't typically stayed in there for long periods of time. Those commodity centric sectors can move pretty quickly. Just like the commodities markets, we've seen move pretty quickly. They took that volatility. Recently. Oh, yeah, yes. Especially recently, they've picked up a lot of volatility and they've used that to the upside. Bear in mind that can also be used to the downside, I would say. So the velocity at which things go up, there's a likelihood that you can also see that velocity downward. That's not an overly bearish or bullish statement, I would say, but it's like a runner. If you take a big inhale, or a swimmer, a big inhale, you're going to have to take a pretty big exhale at some point. So looks like a healthy pullback for commodities right now after a pretty big run. But given the rate hike expectations, kind of some lingering COVID things, it's a pretty interesting environment and certainly unique given the historical data set.
Very much so. I mean, and one of the other points that we both thought was interesting is that typically when you see rising rate environments, you don't see income-centric sectors doing as well, or at least that's the initial thought. Surprisingly, in some of the data that we looked at for this, you really saw that looking 6, 9, and 12 months out, utilities was one of the best performing sectors. And again, energy just popping in there. But also, unsurprisingly, your bellwether of financials is in the conversation too, especially looking really pretty much from 6 months out. Financials are, among the better performing sectors that you see in rising rate environments. But as we noted, each time is different. We can glean historical perspective from a lot of this, but we are currently in what is calling it a cross current type of environment might be an understatement. You also might be hearing that phrase coming from many, many areas. But the reason we mentioned that is, last week in our podcast, we touched on rate volatility. Well, then over the past week, it seems as many things have just been volatile, whether it's U.S. equities, commodities, international, across the board. And there's obviously no better example of that than looking at the crude oil chart, which we did look earlier today, and it looks like it's trading right around that $100 level. And it only felt like 2-3 weeks ago that we were talking about crude rallying above the $100 level for the first time in what seemed like a long time. It ultimately peaked at 130 and has now come back down to that $100 level. So volatility has been very much part of the conversation for the past 2 weeks, and really probably 3 weeks. And some might even argue in 2022. So it just depends on where you're looking. That's for sure.
Yeah. I was going to say something else too. 2021 wasn't the quietest year either, for the record. Markets did on average very well that year, but you had a ton of sector movements, a ton of size and style changes. So this isn't new. It's just looking much different than the market from last year. And to your point about cross currents, and I don't think we're planning to hit on this today, but just a small note I would say is, from our report last week, we talked about kind of rising dollar type of environments, which the dollar has been doing quite well, whereas equities, commodities are finally getting a pullback. The dollar's been kind of steaming ahead for the most part, and that's been a positive. And typically rising dollar environments, there's some macroeconomic things that you can glean from that. And from a capital markets perspective, so sectors, asset classes that do well during rising dollar environments, commodities is not one of them. Certainly hasn't been in the past, at least historically. So this is certainly bucking that trend. And I think that speaks to the prior rising rate environments as well, not just rising dollar environments, but rising rate environments, that there's a lot of other variables going on here underneath each of these market cycles. So there's a lot of action to be processing through here right now, and still seems pretty murky. From an indicator perspective, from a volatility perspective, all of that, still a lot of gray area, I think, for the market to sort out.
And we continue to monitor those indicators. And it honestly may seem like it's a bit of an old story, especially here on the podcast and even on other media videos, as we've talked about these indicators and their field position and reversals up and reversals down. And even late last week, we saw that bullish percent for the S&P 500, BP, SPX, as well as the bullish percent for the Nasdaq 100 reverse down into O's. The BP for SPX sits at 36% currently, but that was the reversal level that it occurred at, and it stayed there. Broadly speaking, looking at the bullish percent for the MISE and even optionable stocks, those still lie in X's, which is a positive sign that we're still technically seeing increase in breadth, although it's kind of been back and forth is the best way to describe it. But looking at all that, it's something that when we're looking at our positions, again, it's going to feel like we're reading an old book, that being sure that your position still maintain buy signals, maintain significant support, and are trading in positive trends. Those are things to keep in mind because they're good ways to understand and help you in the risk mitigation conversation. So if you're seeing your stocks give sell signals and take out support levels and trend lines, so on and so forth, those are probably the ones we should look to address. And right now it's a bit of a challenge because it's sort of, well, where else do I look? But, as we've touched on right now, the things that have shown improvement are energy and basic materials. We're seeing a lot of those pull back, especially towards the latter part of last week and even beginning this week. So they're moving into actionable territory. So that's where the trend has been and continues to be. And we're finally seeing some half decent prices in a lot of those spaces. And I know when looking at some of the models, we continue to see models bring energy exposure in. Now we're seeing some of them bring basic materials exposure in as well. One of the prime examples is the First Trust Focus 5 model. It brought in additional energy exposure as well as materials exposure when a trade last week following Tuesday's action for Wednesday morning. But that's been a common trend that we've seen this month, is just increase in energy, increase in materials exposure. And that isn't the only space we're seeing a lot of that increase in energy exposure continue. I know Will and I were talking about commodities broadly speaking, but we've seen some changes there as well too. So yeah, to say we continue to see changes in rotation would be an understatement, but
yeah. I mean,
the environment we're in.
Yeah, definitely on those equity sector rotation models. If you're familiar with those on the platform, those are pretty loaded up right now in energy, basic materials-esque type of exposure. And this is an interesting thing about momentum models, is because they're not inherently cap weighted. They're not inherently kind of benchmarked to your typical S&P 500 weighting. So what I mean by that is energy is still a relatively small sector of the S&P 500. And these models are taking very aggressive positions on a relative weighting basis, much heavier overweight than your broad market will be. So should this continue to surface, should this trend continue to work out, it could be really great for momentum strategies because they have the opportunity to take these strong overweights. It's also a point of concern, of course, kind of high risk. There's also or high reward. I would say there's also some high risk there. So should that trade not work out, you'd have to see a lot of these models scale out of that energy exposure. But where it is right now, that's been the trend. That's where their relative strength is, even on our commodity focused models, not just equity models, also very loaded up in whether it be oil, energy, natural gas may be in there as well. Don't quote me on that one, but similar type of commodity centric movements on those models as well. And then maybe just a few parting shots here, David, if you want to wrap or add some comments as well. That I was reading this morning in a commentary, and I like being reminded that this is a market of stocks, not necessarily a stock market, where right now you're having certain sectors do very well, certain stocks are still doing very well. They're having healthy pullbacks, in fact, whereas some other areas or stocks in the market are just getting crushed. So it's a market of stocks right now. It's an environment that alpha can be found. If you're looking in the right places, it's dangerous. It's certainly a bit choppy. Tangent note, covered rights right now are really interesting to me. You got a ton of volatility. Premiums are high. Markets are kind of laterally chopping sideways. That's an opportunity, but it gives a lot of credence to that this is a market of stocks right now, and there's a lot of opportunity.
Well, and there's definitely a few adages that you can toss in there right now. I mean, and I've read articles before that, being analysts, we tend to use phrases like that, and sometimes they're quote unquote overused in certain environments, but that one holds pretty true. And the other one that I often remember, especially starting out, that I was always hear Tom Dorsey say is, don't fight the trend. Don't fight the trend.
Yep.
Is the trend is your friend, and don't fight the trend. I mean, they're adages and phrases that'll make you giggle and say, well, of course, like, if you're going with the trend and stocks are doing well and individual stocks are doing well, this is all true. But it holds true. But there is a little irony in the fact that, some might say they're overused, but right now they could not be more true.
Yeah.
And that really is where we find ourselves today is, it very much is a market of stocks, not a stock market. We're seeing fairly narrow leadership and upside participation, within certain sectors. It's a very small basket that are doing so. And even then right now, broadly speaking, as far as asset classes go, you really only have two options. It's domestic equities and commodities, but be really specific in domestic equities. So it's an environment where we find a lot of challenges. We find, definitely some uncertainty, cross currents going on, things that historically speaking are somewhat bucking what we've seen. But, again,
Sure.
every environment's going to be different. We're also in an environment where, again, you're better off making that trend your friend and not fighting it, and just going along with it.
Yeah,
so
exactly.
That'll be my last phrase for today.
Yeah, no, that's good. I think that's something good to keep in mind. It as trend following, momentum shop, if you will. We're looking to take these trends, and we're not looking to pick tops or bottoms. We're looking to capture those big moves and stay out of the deep drawdowns. And right now, not owning the laggards or not owning the losers is probably going to be a winning investment strategy. It is about owning the winners, but I think it's also about avoiding the losers. And that's going to be really, really important right now. So as markets are still chopping around, beware of those trend breaks, attribute changes. Those are ones we got to stay objective with and start moving to the sidelines and watching the indicators as well. A lot of those still in low field position, just chopping around, waiting for some follow through there. Do good things. So that's what we'll say today, kind of all over the place, but I think it was somewhat helpful at least, or you're at least kind of getting into the head of ourselves and seeing what we're thinking and what we're seeing. So if you have any questions and you want to talk to us more specifically, we're always available at phone or email. Phone 804-320-8511 or email dwa@dorseywright.com, also accessible there, and we're happy to speak. So David, thanks for hopping on the podcast this week. Thank you all for listening, and we'll look to speak shortly.